Hi, my name is Mark Walhout, and welcome to the Q4 of 2021 market update. In today's presentation, I'm going to walk through the performance of various global asset classes in the fourth quarter and for the full year of 2021. And I'm also going to spend some time talking about some longer range returns for the global portfolios that I use in my practice. And throughout the presentation, I'm going to talk about some of the lessons that we learned in 2021 and how we can use that insight from this year, but also going back in history, how we can use that insight as we think about how to prepare ourselves for the future as far as investing goes. So I'm going to share my first slide, and then we're going to get into the presentation. So the agenda for today, we're going to start with a summary of 2021 asset class returns, as well as long-term returns for different global asset classes. And this information will sort of help layer in some context around the results that we saw in the markets in 2021. And it'll help you compare how different asset classes perform this year relative to history, which I think is always helpful. From there, we're going to go into each individual geography, and I'm going to talk about how Canada, United States, international emerging markets, fixed income, and real estate asset classes all performed in the year. And then we're going to close with a report on the global portfolios that I use in my practice from Dimensional Fund Advisors, and just show you some historical data which really bring home the fact that risk and return are really related. So the more risk that you choose to pursue in your portfolio, the higher your expected return goes, but also in the near term or short term, the more volatility or ups and downs you need to be prepared to experience to get those longer term returns. So for our next slide, we're going to go into asset class returns for 2021. So in the fourth quarter of 2021, all major equity markets, aside from emerging markets, continued their advances. So 2021 was a fantastic year. Bonds also ended up positive for the fourth quarter. The bottom part of this chart shows a new piece of information that we've added in for the quarter, and it shows average quarterly returns for each of these different asset classes going back to 2001. And what you'll notice is the average quarterly returns for stocks hovered somewhere between 1.2 and 2.4% going back to 2001. So when you compare that to the quarterly returns that we saw in Canadian stocks and US stocks, international stocks, you can see that the quarterly returns in the fourth quarter were a lot higher than what we normally see on average on a quarter to quarter basis going back to 2001. So I think that, the takeaway is that, we had a fantastic year in 2021. Markets were up all over the world. And so, if you held a diversified portfolio that included Canadian stocks, it included US stocks, and even international, you had a really fantastic experience. But it's really just context to see like this is kind of an abnormally high return quarter. And so just history says that, over long periods of time, averages somewhere between, 1.2 and 2.4% for a quarterly return. So that's a 3-month period. And we had a fantastic fourth quarter. And then the final takeaway here is that although emerging market stocks had a negative quarter, they still do have a positive long-term return, quarterly average return of much higher than that, around 2.4%. So, even when we see certain pieces of the portfolio sort of fall out of favor temporarily, that doesn't mean that we decide to move away from them or to ditch those ideas. Fixed income on the right-hand side of the chart was slightly positive in the fourth quarter, and we'll talk about it more later in the presentation. It had a rare down year in 2021. Usually at least in the recent past, like the past couple decades, most years we've seen fixed income go up, and it's actually been a really high returning asset class for the amount of volatility that you take on when you own fixed income. But it had a rare down year in 2021. And we're going to talk more about fixed income later in the presentation, but what's going on with fixed income right now with interest rates being low, fixed income expected returns are not very high going forward, but the role of fixed income has not changed. And my recommendations to clients around how much fixed income to hold does not change, because the main role of bonds is really there to act as your shock absorber. And even in years where we've seen, bonds go slightly negative, they still do perform that important function. They also provide liquidity. They also provide a rebalancing pool so that if your stocks are temporarily down, you can sell off some bonds to get your portfolio back to balance. So fixed income, even though it had a bad year, or relatively like a slightly down year, I don't even want to say that it was a bad year. It still plays a very important role in a portfolio. And again, we're going to talk more about fixed income as we go through the presentation. So now we'll switch to full year 2021 returns and then longer range returns for each of these asset classes. So as I alluded to on the previous chart, in 2021, in the full year, we had unbelievable returns in Canada. In the United States, global real estate was up over 30%. So it was a really, really fantastic year. And so investors who sort of held on and stayed invested through the back half of 2020 and into 2021 have been rewarded very, very handsomely for their patience and their discipline. So asset class returns across the world were fantastic. The only down spot for the year in terms of asset classes was emerging market stocks, which were down 3.37% for the year. And as I mentioned on the previous chart, global bonds had a negative return in 2021. And so, we'll talk, as I said, we're going to go into some specific slides on fixed income. But again, if you look to the 5 and the 10-year returns for fixed income, you can see they've had a positive return over that time frame, even including the most recent year where they've had a negative return. And then as you look at asset class returns for equities over 5 and 10-year periods, very positive returns, but again, not high compared to what we saw in 2021. So I guess the summary point on this slide would be 2021, fantastic year for stocks. We don't expect that kind of return every year going forward, but we're happy about it and we'll take it when we get it. For bonds, we had a slightly negative return, but that's not a reason for us to ditch bonds in our portfolio. They still play an important role. And as you can see, over longer periods of time, they have seen expected returns, or they have seen realized higher returns, and we expect there to be positive returns for holding bonds going forward. And this next chart I really like. It shows the some of the biggest headlines in 2021 sort of overlaid on top of the stock market performance for the year. So we saw lots of different headlines throughout the year. Some of the bad headlines, certainly inflation was the biggest, really scary headline that we saw in 2021. We sort of saw it going on throughout the year. The other thing that's not really noted here in this slide is some of the increased tensions globally, conflicts potentially happening in Russia. That really dominated news headlines throughout the year. So there were a lot of reasons for investors to feel scary and take those opportunities maybe, or think through the middle of the year, hey, it's time for me to sort of step out and sort of see how it goes. We also had a lot of good news throughout the year. So oil saw a tremendous rebound, which is really good for Canada and good for Canadian stocks, which I think a lot of that explains the fantastic returns of Canadian stocks throughout the year. And we saw record highs in Canadian and US equity markets. So we saw really good news. And depending on your view and who you're listening to, you can take good news or bad news as a reason to say, hey, I need to do something differently with my portfolio. But what I love about this chart is that it shows that throughout the year, we had a fantastic year in global equity markets, save for emerging markets. But if you listen to any of those headlines at any given time and said, hey, this is my opportunity to sort of pivot into something else or to get out of the market, that would have been a bad decision. You would have missed out on some significant returns, or maybe pivoted to a different investment that may not have given you the same results. And then the big story, I think, for this chart is sort of that top graphic. So what we're showing here is just the last 12 months. But if you look out, sort of the span of the chart at the top shows $100 invested in 2000 in global stocks is now worth over 3 times that amount at the end of 2021. And so I guess the big takeaway here is with the news and with media and the things that get thrown at us every day, those ideas can sort of grab our attention and seem like signals to make changes to our portfolios to either avoid danger or to take advantage of opportunities. But investors who manage to stay patient and sort of keep a simple approach have seen really, really strong returns for simply staying diversified, maintaining a simple portfolio, and sort of staying the course despite all the different reasons that are sort of thrown at investors to make changes or to maybe panic out or do something different. So now we'll go into individual geographies. So we'll talk first about the experience that we had in Canada over 2021 in terms of returns. So in Q4 of 2021, large company stocks and relatively cheaper stocks outperformed small company stocks and relatively expensive stocks or growth stocks. Over the full year in 2021, value, which is relatively cheap stocks, and small cap stocks outperformed growth and large cap stocks. So as I've spoken about on all of these updates, our portfolios from an equity standpoint tilt towards certain types of stocks that over the long run have seen higher, and in the future, I believe, have higher expected returns. The first type is smaller companies, relatively smaller companies. And then the second type is relatively cheaper stocks or value stocks. So over The full year 2021, those factors outperformed in Canada. So our portfolios outperformed for that portion of the money that our portfolios hold in those types of stocks. Canada's overall market capitalization, this is the chart in the bottom left-hand side of the slide that you're looking at. Canada makes up about 3% of the global stock allocation worldwide. We overweight in our portfolios, or in the portfolios that I recommend to clients. Canada, we hold at about a 1/3 weighting. So there's a significant overweight that we hold to Canadian stocks in our portfolios. And the reason that we do this, there's really three reasons. Number one, for tax purposes. Canadian stocks have more favorable tax treatment for Canadians, the dividends of Canadian stocks in particular, than international stocks, US stocks and international stocks. The second big reason, I think, is behavioral. So there's periods in history where Canada does really, really well, and there's periods where we lag the global benchmark. So for example, in the periods between 2000, maybe even a little earlier, like 1997 through the end of 2009, Canadian stocks did really, really well, outperformed most international markets and US markets. So there's a lot of people that said, hey, I only need to own Canadian stocks. And then we go through periods like from 2010 till around 2020, where Canadian stocks underperformed significantly US stocks. So the reason I like a slight overweight to Canada is simply because if Canadian stocks are doing really, really well from a behavioral standpoint, if I'd like for investors to participate in that so much that, and enough that if Canada's doing really, really well and the rest of the world's doing really, really badly, that it would avoid them making a big mistake and saying, hey, I'm dumping all of my international, I'm going to go all in on Canada right before, Canada goes through another negative period. So there's some behavioral elements to this recommendation, but that's part of the reason why we hold an overweight to Canada in our portfolios. And then the final reason is a diversification benefit. Historically speaking, when you overweight Canada, which tends to be a little bit heavier in things like resources, materials, financials, that overweight has actually shown favorable results when in back tests. When you compare just holding Canada in its market cap weight versus an overweight, we see that the portfolios actually are a little bit less volatile without sacrificing returns. So it's actually been a bit of a benefit for the overweight in Canada. And I just want to note here that that is a historical finding. So we don't know whether that last one will persist in the future, but at least historically speaking, being slightly a little bit heavier in Canada has been a good way to smooth out your returns without sacrificing any higher returns. The next geography that we're going to look at is US stocks. So in Q4 of 2021, value underperformed growth. Small cap underperformed large cap. And the other element that you'll see in this chart is that it shows returns in Canadian as well as the local currency. So the light gray chart shows what the returns were in US dollars. And then the dark gray line shows what the returns were in Canadian dollars. So the Canadian dollar has strengthened a little bit against the US dollar over the past few months, which is why it looks like returns are slightly lower in Canadian terms. Over the past 12 months, so now we're zooming out to the full year, when you look at the chart at the bottom, value and growth have been relatively similar, and small caps have underperformed large caps. And so again, we overweight small and value in our portfolios. So our tilt slightly underperformed in the fourth quarter, but going back to sort of the middle of 2020, those factors have seen significant outperformance. I see no reason for us to change our approach here. The factors go through periods where they perform well and where they don't perform well. We're really shooting for that long-term outperformance. And so a quarter or a year or even 5 years wouldn't change our attitude or our posture on that when we're investing for a lifetime or for several decades. The bottom left-hand chart, you'll see that the US makes up about 60% of the world global market cap, or $60.3 trillion of market capitalization. So we hold relatively less. We hold about a third of our equities in US. And the only reason for that is to accommodate the overweight to Canadian stocks. We need to hold slightly less US stocks. So overall, again, fantastic returns in the US in 2021. And that, as I said, that bottom chart sort of explains how we're positioned in our portfolios relative to the global market cap. The next chart looks at international stocks. In the Q4 of 2021, growth outperformed value, small cap outperformed large cap, and the Canadian dollar strengthened against a blended basket of foreign securities. In the full year of 2021, growth slightly outperformed value and small cap underperformed large cap. And over 10 years, small caps have outperformed large cap and growth has outperformed value. The bottom left-hand chart, you'll see that about 26% of the world's market cap is in international stocks. That's roughly what our holding is. Ours is a little bit underweight, again, to accommodate the overweight to Canadian stocks. And that story is sort of consistent from what we've seen in the US. But again, as you can see, over the year, not as strong returns in international stocks as we saw in Canada and the US, but relatively strong returns over the past 5 and 10 years. And again, we continue to tilt towards small cap and value stocks in international markets, even though those certain elements underperformed slightly over Q4 and in the full year of 2021. For the next slide, we'll look at emerging market stocks. So in Q4 of 2021, emerging markets posted negative returns on all asset classes except for small cap stocks. Value stocks outperformed growth stocks. Small caps outperformed large caps. And the Canadian dollar strengthened against a basket of emerging market securities. For the full year 2021, small cap outperformed large cap and value significantly outperformed growth. And so the tilts that we have in our portfolios towards small cap and value paid off in emerging markets. And so there was some outperformance there. Emerging markets holds about 11% of the global market cap, and we underweight emerging markets slightly to accommodate the Canadian overweight once again. So strong returns over a longer period of time in emerging markets. But as you can see in the quarter and in the year, small cap did really, really well, but other asset classes not so well. But then again, as you span out over 3 and 5 years, strong positive returns in this asset class. And I like having emerging markets in the portfolio. If you believe that, the next, great ideas and development is going to come in those geographies, I think it's wise for us to hold some stock in emerging markets. So continue to believe that makes sense for long-term investors. And then this chart shows country by country returns, sort of going from the left. The highest returning country in Q4 was Egypt. And on the very far right, the worst performing country was Turkey. And you'll see that Canada was in the top third, right next to the US. The global portfolio, the balanced global portfolios is still sort of roughly in that top third. And really the big takeaway from this chart is that we do not know where the highest returning stock markets are going to be in advance of a year. So the wise thing is always to sort of spread ourselves out all over the world. So if you hold, any of the Dimensional Fund Advisors global portfolios, you do have equity allocation to each of these geographies, roughly, next to their market capitalization or in line with their market cap, save for Canada, which is a slight overweight. But my emphasis here is, we want to capture the returns of a country like Egypt when it outperforms. We just don't know when it's going to do that. So we have to sort of have a little bit of our eggs in every basket, so to speak, in terms of how we allocate our portfolios across the globe. For the next slide, we're going to show the performance of global real estate investment trusts. So I haven't shown a slide on REITs before. We do own REITs in our portfolios. And when you hear REIT, think of like commercial real estate, commercial, residential, commercial, like plazas, malls, things like that. As you can see, real estate did really, really well in the United States, did really, really well in Canada, as everybody knows. So we do have an allocation in the portfolio to global REITs. We hold them roughly proportional to their market capitalization. The publicly traded global REITs, that market cap is roughly $2 trillion. So we own, usually in the global equity basket, that works out to be between 2 and 4% of our equities are allocated to REITs. Real estate or real estate investment trusts have proven to be a really good diversifier and a good inflation protector over the long run. And as you can see, really, really strong returns over the past 10 years. US REITs have returned around 13.12%. So fantastic returns for REITs, sort of bookending the really, really good returns we saw sort of across the board in equities, aside from emerging markets in 2021. So for this next slide, we're going to talk about fixed income or bonds. So a few takeaways on this chart. First thing, we'll talk about Q4 returns. So in the fourth quarter, long-term bonds did okay. They did about a 1.5% return for the quarter. Short-term bonds did not do as well. And that's possibly signaling an expectation that central banks around the world are going to start to raise short-term interest rates. That seems to be the consensus in the media for the most part right now. And the way that that works is if a bondholder expects that short-term rates are going to rise and they want to get ready to buy a new bond that pays a higher rate of interest, that investor would need to sell that bond at a discount. The buyer of the bond knows the same thing that the seller knows, so they won't pay the same price for that bond, which is why short-term bonds, when there's an expectation that central banks are going to raise short-term interest rates, those bonds are going to go down in value. If you look at one-year returns, longer-term bonds have not done as well, or they've done worse than shorter-term bonds. It's possible that long-term bondholders are anticipating potentially higher inflation. That could be one reason for it. Again, I don't like to attach narratives to results as much as I can avoid it, because we don't know the individual motivations of the tens of thousands of different participants in markets. But that would fit. Long-term interest rates tend to reflect, in terms of treasury markets anyways, what the expectations look like for inflation. So it's possible that that there's potential that higher inflation is expected, and the long-term interest rates would reflect that. And then we look in the top right-hand chart on this chart, or on this slide, or the top right-hand graphic. We look at bond yields, and what I want to illustrate here is that U.S. bond yields, 10-year U.S. Treasuries are currently yielding about 1.52%. So that's roughly the expected return for holding a 10-year U.S. government bond to maturity right now, is about 1.52% per year. But as you move towards corporate bonds, so AAA or AA rated corporate bonds, and then further to the right to slightly lower rated A or BBB corporate bonds, you see higher expected returns. And the portfolios that we use, that I tend to recommend at Wellhoe Financial from Dimensional Fund Advisors, they do pursue the premiums that we see for holding corporate bonds and slightly longer term bonds. So the idea that there's no yield, or there's no return to be had from owning bonds right now, I think might not be correct. There is still reasonably a reasonable expected returns for holding bonds. And when you think about the other features of bonds and the things that they do in the portfolio, I continue to believe that owning bonds and also owning corporate bonds makes sense, as long as it's done properly, and you're using high quality bonds, or you're targeting high quality bonds, and you're targeting bonds that are not as long in duration, they're not as long term. They tend to be a really good mix for the equity portion of your portfolio. And now for the next slide, this is a chart showing different global yield curves. So we're showing the yield curves for Canada, the United States, for the UK, Germany, Japan, and Australia. And so basically the way that these yield curves work, so that at every different maturity point, so 1 year, 5 year, 10 year, 20 year, basically that's the expected return that the market believes, or the way that bonds are priced, the way that the prices are indicating what the expected returns are going to be for each of the treasury bonds at different points on that yield curve. And so the way that it works when you're building a fixed income portfolio is you want to target points on the yield curve where there's a nice positive slope. So when the slope moves kind of from bottom left to top right. And so what you can do, if investors are sitting there saying, hey, there's no yield to be had in Canada, for example, or we don't like the yields that are being offered in Canadian government bonds, you have a couple of options. As I said from the previous chart, you could target higher expected returns from owning corporate bonds within reason, right? I think that there's certain types that should be avoided, but high quality corporate bonds that are relatively short in duration, I think those still offer some higher expected returns for investors. So that's being factored into the way that portfolios are being constructed. And then the other thing you can do is you can target international yield curves. So as you can see on these different yield curves in the United States and in Germany and on Australia in particular, I see a nice gently sloping yield curve. There still is potential to target bonds on that yield curve. And the cool thing that you can do with fixed income, if you look at a country like Germany, their short-term bonds are actually showing a negative yield. So if you hold a short-term bond in Germany, it's actually maturing below par. But what you can do is, if you hedge that for fixed income investment to Canadian dollars, you can still target higher returns on the yield curve in a foreign market and get get positive returns if you're hedging that investment back to Canadian dollars and you hold that bond to maturity. So to say that we only have one option in bonds, and you look at the Canadian yield curve and you might say, there's no way that we want to invest in bonds. They are such a paltry investment right now. They're not showing a lot of positive expected returns. You can target different geographies. You can use hedging, and you can also use corporate bonds wherever it makes sense and within reason. And again, as I said, with the portfolios from dimensional fund advisors that I recommend in my practice, we tend to focus, or the portfolios tend to move a bit more towards shorter term bonds. And shorter term bonds, the reason why they're preferred as a diversifying asset in a global portfolio is that they don't move around as much with interest rate moves. So that's a lot on fixed income. And when we talk about yield curves, it can get a little bit lingo-y and a little bit confusing. So I appreciate you kind of sitting through that portion of the presentation. But again, just to reiterate what I said at the beginning of the presentation, I'm not changing my recommendations to clients around how they allocate to fixed income. I've read a lot of things about people saying, hey, you should totally ditch fixed income because it's not offering high returns right now. And I think that's just not a very good idea. We should be prepared that fixed income will offer us lower returns going forward, but they still play a very important role in portfolio construction, and especially for people that are getting ready to take money out of their portfolios in retirement, to sort of lower the volatility of the portfolio, to offer you liquidity or the ability to take cash out of the portfolio, and also to help with rebalancing. And then now on this next chart, we're showing a slightly different look at the different global portfolios. So as you can see, for the full year 2021, fantastic returns in 100% equity portfolio. So the 1 year FY 2021 return of a 100% equity portfolio, roughly 23.6%. And then as you add more fixed income to the portfolio, as I just talked about, bonds didn't have a great year, relatively speaking, over the past several years in 2021. But again, if you had a portfolio that was roughly 60% stocks or 40% bonds, you still saw a return roughly somewhere in that 13% range. And so the purpose of this chart is to just sort of, again, reinforce the relationship between risk and return when you're thinking about how you're building out a portfolio. So if you're somebody who's starting out in your career, you're starting to save towards your retirement goal, you can afford to take more equity risk in your portfolio, because it's not likely that you're going to need to tap into those funds in the early part of your working years. You're saving that money for retirement. As long as you can withstand the volatility of owning that portfolio, then you have a higher expected return. And the chances are, as far as history is concerned, that history tells us that owning more equities tends to show you higher returns over long periods of time. If you're somebody who's a little bit more risk averse and you don't like the bumpiness of the portfolio, or you simply don't need to take that risk anymore, or you're getting ready to draw income off your portfolio, we're going to recommend, or you'd want to consider owning more fixed income in your portfolio. And then the lines at the bottom of the chart, I love pictures, and I think that the lines really tell the story. So the more stocks that you own in that portfolio, the more your returns have been since 1994, the beginning of this chart. But you've also seen much more bumpiness, much more volatility. And ultimately, that's the trade-off. If you want to pursue higher returns in a portfolio, you need to be ready to withstand more volatility. And at least historically speaking, again, we don't know what the future brings. But because stocks are more risky than bonds, we do expect that relationship is going to continue to exist, that higher returns should be expected in stocks. For the investor who manages to remain patient and sort of stay the course, they can expect that this relationship should continue into the future. But again, we don't know. So again, the key takeaways: markets have historically rewarded discipline for investors who are able to stay the course, to sit through those periods of short-term volatility. The second big takeaway is that keeping it simple works. So these portfolios that I'm showing you, they're a close approximation of the managed portfolios from dimensional fund advisors. But these are all just basic portfolios that you could construct with simple index funds. It didn't require you to know what was going to happen next in the markets. It didn't require you to find the right times to jump in and out. It didn't require you to have, the hottest stock tip or the next best idea. These returns were available to somebody who just said, I'm going to spread my investment portfolio out all over the world. I'm going to sit there and, sort of like watching paint dry, just sort of let it happen. these returns that I'm showing you on this chart were available to the investor that sort of took that approach. So keeping it simple does work over long periods of time. And then finally, the big takeaway is that, you know, the asset allocation that you hold should be a reflection of your financial plan. And so I mentioned my example at the beginning of this chart, you know, the young early investor who's got lots of years ahead of them, that's okay to withstand the volatility. Owning a lot of stocks makes a lot of sense. For somebody who's on the doorstep of retirement and needs to start drawing income off their portfolio, they're relying on that portfolio to give them their paychecks now, not their job. You know, they may want to think about owning something a little bit more balanced, adding a little bit more fixed income to that portfolio. But ultimately, you know, your asset allocation, the mix of stocks, bonds, cash, has to fit your financial plan. It has to fit your ability to take risk, your ability to withstand volatility. It has to line up with your willingness to take risk. Just because you can take, you know, more risk in your portfolio and own more stocks doesn't mean that you want to. So your asset allocation should reflect your willingness to take risk. And then finally, the portfolio should reflect your need to take risk. So if you're, you know, the saying from, there's an author named William Bernstein, or Bill Bernstein, he writes a lot of books on asset allocation and investing. And he says that the reason that Bill says, he says, if you no longer need to play the game, you can stop playing. And so the idea that you need to continue to take, you know, a high amount of equity risk in your portfolio as you're kind of getting to the point where you no longer need to take that risk, he questions whether that makes sense. So I hope that you found this presentation helpful and interesting. If you have any questions, please reach out to me anytime. And I hope that you're having a fantastic day, and I'll speak with you soon. Take care.